watching the global edition of Russell Market Week in Review for the week ending July 25th, 2014. I'm Kate Stouffer, coming to you from Russell Investments Global Headquarters in Seattle, Washington, and I'm joined by Senior Investment Strategist Doug Gordon. Good morning, Doug.
Hi, Kate. Nice to join you.
Good to have you here. So let's start off talking about some of this geopolitical risk that we've been seeing that certainly dominated the news this week, kind of trumping some of the other data points that we saw. Talk about some of these watch points.
That's exactly the case. We came in the week. I guess the way I think about this is if forecasting macroeconomics and financial markets is difficult, forecasting geopolitics, especially when Vladimir Putin is on the other side, is even more challenging. But that's certainly what dominated the markets at the start of the week. Certainly there's kind of two scenarios that we could see kind of coming together, but we think that the central scenario is that these will wane, though we'll have to keep an eye to it. When we look at Ukraine, the potential for economic impact is probably a little bit higher than, say, in Gaza, and that's because of the potential disruptions to energy markets, particularly in Europe, and we think that those would be inequitable between Europe and the United States. Gaza probably has the higher top escalation threat, but we think that that's a low probability as well. And that's because, as we've known for 4+ decades, that the Middle East has that potential to be materially disruptive, again, to energy markets, though when we're talking about Gaza and Israel, we're not talking about energy producing countries, so not directly, it would only be in an escalation scenario. It's taken the market a little bit of time to kind of move through that, and again, I don't think they're totally off the front page potentially, but once we kind of got through that, we did have a couple macroeconomic data points this week that, to a certain extent, continued the validation story.
Yeah, talk about a couple of those. There's durable goods, jobless claims. Expand on that a little bit.
Sure. So on Thursday, of course, we had the weekly jobless claims coming in at 284,000. It continued that trend on the 4-week average at 309,000. Again, a very good picture, and we think that that will help to inform a positive picture with respect to non-farm payrolls that we'll get next week. And then durable goods this morning came in above consensus, both the full number and then also ex-transportation. And so both those things we think at some level keep this validation story. But it's a case where, remember where we're coming from, right? We started the year with that really soft on third revision first quarter GDP number at -2.9%. It's as if we missed the first test of the class. And now to pass the test, each one of those other tests we have to do that much better on. So every data point that we get as we move forward becomes that much more important.
So as we kind of move outside of that and look at Europe specifically, besides some of the geopolitical events that we already talked about, they also had some interesting events happen this week with the Bank of England minutes coming out and also the composite manufacturing index number coming out as well. Talk about that.
No, exactly right. Obviously, Ukraine is a bigger event in Europe, and it's obviously been a tragedy to of course the people of Holland, but everywhere. You can't imagine the unfortunate that's happened in Malaysian Airlines. MH17 this time, MH370 early in the year. Really, really unfortunate. But would that we can move through that, and I think the risk there again is that we've got kind of a sanctions versus curtailing of energy production. If that comes to a case where it's Europe versus Russia at some level, it's probably going to be later in the year as we get into winter and those energy resources become more important. But if we can move through that, we had data points there that certainly were modestly positive. We had a unanimous vote in the Bank of England's minutes about keeping the rates steady, and that certainly emboldened markets to a certain extent. And then, as you mentioned, we had the manufacturing index increase from 52.8 to 54. So it certainly hasn't cleared the picture in any way, shape, or form, but at least a little bit of data that's a little less concerning, but it certainly affirms why the ECB is pursuing the monetary policy, the accommodative monetary policy actions that they are right now.
Well, there was certainly a lot that happened this week. There were fewer data points maybe that were coming out, but I know that's not the case for next week. There's a lot that's on the docket, so talk about that a little bit.
Sure. If this week had fewer data points and allowed geopolitics to kind of dominate markets, next week, well, we'll keep an eye to that. Next week, we have an absolute slew of data that we think is going to be really impacting upon markets. On Wednesday, we've got the first blush of the second quarter GDP number, which again, given how soft that number was before, this becomes that much more important. You know, markets are probably more concerned with where we're going than where we've been, but this will be really important in terms of where we're going. Also, we get an FOMC announcement on Wednesday as well. We anticipate that will affirm the steady state with respect to the taper at $10 billion per month. But again, that's going to be something that certainly will catch the market's eyes. At the end of the week, we get two other really important data points, actually three as I think about it. We get, of course, the non-farm payrolls number, as we talked about. This is that next test that we have to pass, right? We anticipate it might be a little bit lower than this very strong 3-month average that we have right now at 272,000. And that's because there's seasonal adjustments that are in place every year. And because of that particularly cold winter that at some level informed that soft GDP number, there are a lot of snow days. So a lot of teachers and public sector workers have extended into a part of the year that they normally wouldn't work. And so that will be a little bit impacting on the seasonal adjustment. We think some of that will fall off. We anticipate a number somewhere in the range of 230,000 come next Friday. Additionally, we get the ISM Manufacturing Index on Friday. Again, that's more of a forward-looking indicator or more of a current indicator versus maybe GDP that's a little bit more retrospective, so that second quarter GDP number is certainly important. And finally, we get personal income and expenditure on Friday. So all those things will focus the market's attention, I think, back on data, provided we don't have any material escalation out of Ukraine or certainly in Gaza.
All right, thank you so much for your time today, Doug, and your thoughts. And thank you for watching Russell Market Week in Review. We'll see you next time.